This
This is
conference will now be recorded.
okay. Yeah, let's go ahead and get started. Welcome to our Investor Insight Monthly meeting. Today's topic is going to be investing during times of market volatility. And welcome. Thanks everybody for joining. And my name is Patrick McGinnis, and I'm a portfolio analyst here with DBHW Wealth Partners. And I have a few roles. Primary one is as portfolio analyst is working on our investment models and offering that support to our financial advisors and choose from industry leading investments and investment opportunities and assemble appropriate investment models for people's individual risk tolerance situation. I also handle transactions for clients if clients need to create some more liquidity for something. I'm involved there. I handle rebalancing of our investments to make sure that we're investing to the right tolerances. And I also handle tax preparation when we're in the tax season. So I see a few different areas, but for this, we wanted to open this call up to clients to give more visibility on our investment process. And that's why we invited Nick Moss with Columbia Threadneedle today to describe Columbia Threadneedle and his views on the markets. So we are invested in the Columbia Dividend Income Fund in our DB models, and it's a large cap value dividend oriented income strategy. So it's a good defensive strategy. Still, it's still invested in the stock market, but it's a little bit more defensive during times of market turmoil. So we invited Nick on. He's an expert in mutual fund investing and on market conditions and just really on all things Columbia Threadneedle investments. So we'll get into that in a second. Nick has a prepared presentation, so he'll make that for a few minutes, and then we can go into questions and answers after that and answer any questions that you might have. If you have a question, you can raise your hand, and I'll unmute you, or you could type it in the chat, and then we'll answer chat questions. So I'd also encourage everyone to share these type of presentation opportunities in the future. Share it with your other friends, family. We'd like all of our clients and any potential clients to be able to join in. One other thing is that we are going to be talking about current financial conditions, but we aren't going to really get into the election here. We're not going to talk about a specific candidate or their likelihood of getting elected or not. So we're just really not going to go down that road in that area today. Okay, so that's what I have, and I'd like to introduce Nick Moss, Regional Advisor Consultant with Columbia Threadneedle, and as his title implies, he's a consultant to financial advisors. So Nick, thanks for joining, and it's been some pretty interesting times, and like to hear some viewpoints on some of this turbulence and volatility we've been going through. Thanks for joining.
Yeah, absolutely. I appreciate everyone here having me today. Thank you very much. If you could pull the screen up for me, Pat, here, and
sure
I can
thing.
kind of talk while the screen's being pulled up. But
okay.
No, I just want to say thank you. I work for Columbia Threadneedle Investments. We are a leading asset manager around the world, where we manage roughly $650 billion for clients, whether they're large large institutions down to kind of the kind of retail client. So really across the board, you may see our portfolios in your employer 401k plans. So we are truly everywhere, whether it's from mutual funds to ETFs to models and accounts. We have all the different kind of wrappers and flavors of investments for our clients to go out and kind of really meet their need. And our firm is really focused on research as really the driving force of helping us make the best decisions for our clients. And currently on the screen here today, if you go to that next slide for me, Pat.
Sure.
So every 6 months, the global asset allocation team here at Columbia Threadneedle, so this would be the head of our global equity group, the head of our fixed income group, head of alternatives, and a few of the analysts will all get together and they'll just kind of talk about everything that they're seeing across the globe, across the world, kind of within their respective, their sort of sector, whether it's stocks or bonds or equities. And the slide that's up in front of everyone here today is our most requested chart from advisors and clients at any given time, because it's very powerful. Because when it comes to investing, if you're putting money into a stock, a mutual fund, an ETF, the whole process there is that you're doing it for long-term growth and success to help kind of meet your end goals. And that's kind of what this is really geared for, because in the very, very short term, whether it's a week, a month, or even the next year, that's considered very short term. And as an investor, we are not trying to invest just for the short term. We're investing for the long term. While a lot of noise can happen in the short term and can create a lot of emotion and it can kind of scare people. And I mean, there's no better example than, the past year or so here where we've got the Fed having interest rates at 0. They brought them all the way up to 5.5. They're starting their process to bring rates down. We've seen significant inflation. There's been a lot going on that can really kind of scare, any sort of investor. But if you're invested for the long term, these kind of really small term or short term issues really shouldn't have an impact on your day-to-day life in terms of your investment portfolio and what you're trying to achieve long term. So up on this screen, we do this really simple exercise about every 6 months. And if you look from kind of left to right, you're going to see in that kind of darker green are kind of equities. So think large cap US stocks, smaller companies, international companies, and then emerging market companies. That light green are all things kind of known as bonds and fixed income. Then on the far right, kind of more alternative asset classes in there. But the biggest takeaway on here is that every forecast for each of these sectors is positive. We don't have an outlook on really any kind of large allocation here to be negative. And over the past 8 years that our team has been kind of analyzing this and kind of putting it in a chart like this, we've actually never had a single asset class have an expected return be negative. And I think that really speaks to the power of, yes, there's a lot of noise at any given time, during the course of a day or a week. But if you just kind of put that to the side and just look longer term, most things tend to be positive. If you continue to invest for the long term, there's short-term turbulence, but usually there'll be long-term gains. So an example here would be, if you look kind of across the board, but right in the middle on those light green bars for bonds, right? Bonds have had a really tough go at it. Prior to 2022, we had really low interest rates. Come into 2022, and then all of a sudden we saw interest rates move very quickly, much higher. And from a bond investors, their biggest concern is, rates moving higher, because if rates go higher, the bond prices actually go down. They have an inverse relationship. But if you see here though, and with yields much higher today, as you've probably noticed with your maybe CD rates and money market rates, or even if you own some bond funds, all those yields have gone up much higher than prior to 2022. And the biggest kind of, the biggest area of return in the bond market over the long term is your current income. That is where you really drive a lot of that return. So since yields are much higher, we can actually now forecast out some pretty good returns in the bond market again. And it's been a really long time, going back to the financial crisis of 08 and 09, where yields have been really this high in the bond market. So bonds are now really beginning to again act like true bonds and be a diversifier away from a lot of equity risk. So we're really happy to see this, but at the end of the day, I think the biggest takeaway here on this chart is that the forward-looking forecast over the next 5 years is for positive returns. I know there's a lot of noise on TV that can kind of scare us all, but long-term, we are long-term investors, and this is what really kind of drives us going forward to continue to be allocated and invested in the overall market. If you could move down to that next slide for me, Pat.
Okay, can you see it?
Yep, I got you. Thank you. The chart here is a internal model that our team at Columbia built about back in 2003. So we're running on 21 years. And the whole idea here is to have our kind of own internal view of the economy, kind of based off the consumer, which is that purple line you see in the chart, from a corporate standpoint, which is that light blue line, and then that dark kind of blackish is a combination of the two. And all we're trying to do as investors and as analysts, and as we're trying to figure out where is the economy going at any given moment, is we kind of pull this together looking at a large grouping of kind of current market indicators based off what is the consumer doing, what are corporations doing, and we kind of have a model that will show this. So if you're looking at the right-hand part of the chart, say around 2021, 2022, where that big peak is on there, what's really interesting is at that peak in sort of the overall strength of the consumer and corporations, there was a lot of talk going on in the news about an upcoming big recession. The Fed is about to start embarking on a massive hiking campaign. And all of a sudden, everyone got really scared. Everyone got very nervous. But if you look at this chart here, and at that peak on the top right, and if you look to the left over the past 20 years, consumer strength and corporate strength had never been that strong before. So we actually entered that hiking cycle with the most kind of well-managed balance sheets that we've had in over 20 plus years. So even though that the Fed was out there to slow the economy down, which they absolutely did, as you can see that on the right-hand part of the chart, as those lines are moving lower, the consumer was slowing, corporations were slowing, but they didn't collapse. That's because we came into it with so much resiliency and strength at the same time when everyone who was looking at it said, well, if the Fed is going from 0 to 5.5 on interest rates, we are bound to have a huge recession. And that just wasn't the case. The consumer was extremely strong, very well positioned. And we really haven't had that massive slowdown. Yes, the market itself in 2022 was not great, but outside of that, I mean, we've had a fantastic run so far through last night, and you could add on today. We're up about 22% within stocks in the US. So that is a phenomenal number in any given year, but especially one with the interest rates as high as they are, and as the Fed trying to be as restrictive as they were, for the market to be up all over 20+%, I think is a huge win and a testament to how strong the economy is. If you could jump down about 3 slides for me, Pat. Slide number, yep, right there. Thank you.
Okay.
And this is the big reason why. So this is the earnings forecast for this year, 25 and 26. And all that really is a fancy way of saying profits. Do we think that US companies, international companies will continue to grow and generate profits? Those companies will continue to make profits from who? Us as consumers, as we continue to spend, buy goods and services. That will continue to help all these big corporations. And you can see the forecast for next year on the far left for the US, that light blue. We actually think that corporate earnings will continue to grow. And what's really interesting over time, I don't have the chart in this deck here today, but if you look at corporate earnings or corporate profits over the past 50, 60 plus years, and then if you were to have a line of the US equity market returns on that same chart, they are nearly almost 1-to-1. Stocks react to profits and earnings. So if we think earnings and profits will continue to grow, at the same time, it's a pretty fair assumption that more likely than not, that the market will begin to also follow and hopefully begin to move up as it reacts to those great earnings that a lot of companies are potentially having going forward from here. If you go down to the next slide for me, Pat. Perfect. So the chart here is highlighting the impact of owning dividend paying stocks and what that looks like. Now, what's been really interesting, and over the past couple of years here, all the talk on TV, and on the internet, on the papers, it's all been about AI and technology and names like NVIDIA, right? They've done phenomenally well. They have huge returns going forward, or over the past few years. So while tech has really been driving the market substantially higher, as there's a lot of innovation, there's a lot of thought that this is the next kind of big thing, at the end of the day, to maybe kind of offset a little bit of that exposure and risk, is on the whole other side of the spectrum, and it's dividend paying stocks. They're really, really boring names that continue to generate significant free cash flow that allows them to go out and pay a consistent and growing dividend over time. And if you look at the chart here, what's really interesting on that far kind of right bar that has the little blue box around it, from 1930 to 2023, roughly 40% of your return in the S&P 500 has come from the income from dividend paying stocks. And about 60% of the return in the S&P has come from price appreciation. So for nearly 100 years almost, 40% of the return is from dividends. So if you're a big high-flying tech company, almost like an NVIDIA, which pays a very, 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 very tiny small dividend, those are driving the market on price. But if you look at it from an income standpoint, your big stalwarts like your Walmarts, your Johnson & Johnsons, JP Morgans of the world that are large established companies that can pay dividends, those will have a tremendous return on your portfolio really over the long term. And if you go down to that next slide for me, Pat, this is what's really important right now too. Oh, there we go. Thank you, Pat, sorry. If you look at it here from 1973 all the way through 2023, through this summer of 2024, the top returning were dividend growers and initiators. So if there's a company out there that's constantly kind of growing that dividend over time, or a company who is brand new and they start issuing a dividend for the first time, you've averaged just over a 10% return over this time frame, with volatility of about 16%. Now, on the flip side of that, if you look down about 4 rows to any sort of stock that is trying to cut their dividend, or they got rid of their dividend. If they got rid of it on a whole, you would have actually lost money over the past roughly 50 years. You would have had a negative 0.67% return, and your risk would have been 25%, which is very significant in terms of investing. So it's really important that if you're going to be investing across the board, that you're investing in sound, very stable companies that can really generate significant cash flow, because that cash flow is a really good indicator of corporate health. And even if you look down just the one level below for stocks that don't pay a dividend, you're up just over about 4% with a higher kind of volatility level. So for us, I think for the market, having free cash flow, paying a dividend, it really highlights the strength of that company to pay it out, but also probably deliver very strong earnings as well. If you hop down about 2 slides for me, Pat, where it says US mega caps, one more. Thank you. So there's been a lot of talk, obviously, about the Magnificent Seven, the Teslas, the Nvidias, the Metas, the Netflix of the world are growing bigger and bigger and bigger. And I just thought this was a really neat chart that goes back to 1995, showing the 5 largest stocks in the S&P 500 and the percentage of the S&P 500 that they made up. So currently today, the top 5 stocks make up almost 30% of the S&P. You go back to 1999, kind of during the dot-com era, it was only about 17%. So yes, it is much higher than normal, but at the same time, these companies are much different than where they were, 20 plus years ago. I think we all know the analogy during the dot-com of really any company was just throwing the name .com. So there was the pets.com, there was all these that were just showing up and trying to hop on the train, and it didn't really end all that well for a lot of those names. That is not the case today, where you have names like Nvidia and Microsoft that have tremendous amounts of cash on hand, and Apple, right? So those names and those companies aren't going anywhere anytime soon. They're much more well established. So yes, they are much more of a larger chunk of, say, the S&P 500. There's a lot of great names that are not in that top 5, but this is a very different dynamic than where we were about 25 years ago, because those names back in 1999 were not as strong, were not as well capitalized as the biggest names are today within tech in the overall market. If you could hop down 2 slides for me, Pat, and I'm going to make a gamble here on this, because I know this is on everyone's mind. We are not making a forecast here at Columbia Threadneedle as to who is going to win, what the policies are going to look like. We have no idea. We are not shifting portfolios here based off who we feel might or might not win. That is not what we do. But I think this chart is really important, because I understand that the election is very emotional for a lot of people. A lot of people are very invested in it personally. But when it comes to your money and your long-term wealth and success, at the end of the day, it doesn't really matter who is in charge, who is in the Oval Office. And that's what you're seeing on this chart here, with all the different combinations of a Republican as president, a Republican-controlled Senate, maybe the Dems control the House. You get all the different scenarios on here. And for the most part, they're all pretty much the same. If you go back to the one that has the negative 17, that big outlier, that was from George Bush, when we had that kind of post.com, we had 9/11. There were a lot of factors in there that really probably weren't related to as to who was controlling what part of Congress. So I always just kind of like this slide around this time of year to highlight, let's not make emotional decisions based off what we personally feel who may not win in an upcoming election. Because once again, we are investing for the long term here. And the one thing that we are looking at here at Columbia Threadneedle that we can't make a call on today, of course, is that if there is one party that assumes complete control at some point, I think that will change the narrative a little bit on what policies could look like, but we just don't know the rules to the game yet. That may change come after the election, depending on who gets elected and whatnot. But currently, at this time, we aren't making changes. We're not, trying to make a call really on either party or either candidate here. And then I'll just wrap up with just a few more slides here. If you hop down one slide for me, Pat. I always really like this slide because sorry about that. It's the mute button.
Okay.
So if we go back to 2022, right? Most investors, especially those that are kind of nearing retirement or in retirement, tend to maybe have an overweight within bonds and fixed income. They're lower risk, they're more stable. And we all know in 2022 was the worst year in the bond market on record. You're down over roughly 14%. You have to go back to 1994 when the bond market was down a whopping 2.9% as the previous worst year in the bond market. So 2022 was absolutely horrible for bonds. But if we fast forward to where we are today, we really don't see that same scenario playing out again. And I know the wounds are still open and they can still be painful. And a lot of folks say, I don't ever want to own a bond again. But if you look at the chart here, because the big thing with bonds, it's very, very math heavy. So if you were to think about the chart here, if you go back to 2022, 2021, when bond yields were really low. So say an example would be on the left column. If you see the number where it says 1.5, the 10-year bond starting yield. So yields were very low just a few years ago. So if you're on that 1.5 column and you go all the way to the right and say rates go to 2.5%, you will lose about 7.2%. And we know that interest rates went higher than that. It's off the charts. That we don't even have it on here to show what that math would look like, but we know the performance and what the pain was. But fast forward to today as to where we are now. Just earlier this year, we had the 10-year treasury was nearing 5%. So the very bottom row on the chart here. And then rates have actually moved down quite a bit this year. We're just under 4%. So if you go to the bottom row, that first column where it says 5, and then the column right next to it that starts with -100, that means if rates go from 5% to 4%, what's the expected return? It's about 13%. But what if rates were to move higher and they went from 5% to say 6%? You would go to the far right column here and see you would expect a loss of only about 2.3%. And the biggest reason why is you have so much income and yield to help offset any sort of price losses from rates moving higher. You didn't have that luxury just a couple of years ago when rates were very, very low. You didn't have enough income to offset that price loss. So now, based off where we are currently today, we feel really good that even if for some reason that rates were to move significantly higher, you have enough income and yield to help offset that and really kind of cushion the blow from a price return standpoint. And then if you go down just to one more slide for me, Pat, I always like to talk how the equity markets are always kind of forward looking, trying to predict where things are going. The same is true within the bond market as well. So back in Q4 of last year, we heard from the Fed that they were talking about, you know what, we are done hiking. We're going to be pausing interest rates. And how the market kind of took that was, well, if they're done hiking, their next move is probably lower. We don't know when, but it will be coming here at some point. So the market actually the rates started to actually move a little bit lower before the Fed even moved just last week. And what you see on the chart here on the left-hand side is that when the yields peak from the Fed, all the way out to the first Fed rate cut that we just had, on average, you make about 11% within fixed income. So when everyone is really concerned and nervous and they're loving their money markets at 5%, there's actually opportunity out there to actually be forward looking and go get back into the bond market. And we've seen that happen historically. It's not on here on this chart, but we've seen that very same scenario play out again. On average, over the past 12 months, the bond market's returned almost 11.5%. So really close to the average here again. And then that kind of middle chart and the one on the far right will show you on average what returns have been 6 months after that the Fed cut, and then a year after that the Fed began bringing rates down. So there is still plenty of opportunity within fixed income. And our big take here is this may not be the best time to have excess cash that you don't need on a short-term basis to be hanging out in a money market or a really kind of short-term cash-like instrument. That there may be other opportunities out there to maybe make a little bit better of a return based off your risk tolerance here today. So I know I've been talking here for a fair amount, but I just kind of wanted to say really quickly, yes, there's a lot of noise going on in the world today. There's a lot of news, different things that could really kind of make you be nervous about investing. But if you're investing, you really should be, if you're buying stocks or bonds or whatever it may be, you should be doing it not for the next 2 weeks or for the next month. You should be doing it for the next couple of years, 2, 3, 5, 10 plus years out there to achieve your goals, because we do know the longer you stay invested, the odds of you making positive returns goes up substantially. So I'll kind of end my prepared comments there, Pat, but if there's any thoughts, questions, I am happy to take them here. So.
All right. Okay. Well, thank you very much, Nick. Excellent comments. I like your outlook for longer term investing. I appreciate that, and I hope we all learned a lot. So we're going to open this up to any questions anybody might have. And if you have a question, you can raise your hand up. I'll unmute you, or if you prefer to send in the chat, you can do that too. And then while everyone's getting their questions in line for you, Nick, I'll ask specifically about one of our holdings, and it is the Columbia Dividend Income Fund. Many of our clients are invested in the Columbia Dividend Income Fund through our DB model. So could you describe some of the impacts and positive impacts that this investment can have on a portfolio, either standalone as the fund or just the positive benefits that we're going to get from being invested in dividend income fund?
Yeah, absolutely. So this is our kind of big flagship portfolio here at Columbia Threadneedle. And I mean, I always kind of joke, if you've never invested within anything in our entire lineup here, I always say start with the dividend income fund, because you know exactly what you're going to get. It's never going to blow you up in the middle of the night and have some very unexpected kind of return profile. It's designed for trying to target sort of the most pristine balance sheets within the US. So we are squarely focused on free cash flow, and are the stocks that we're investing in able to grow and maintain that dividend over time? And we really kind of look at that through the lens of free cash flow. We don't really care so much as to kind of how high that dividend is being paid out by an individual company. But for us, it's really more about, if it's a high dividend, is there enough cash on hand and in reserves to continue to grow that over time, or at least try to maintain that dividend? And our portfolio managers on that strategy are constantly meeting with these big companies, the CEOs, the CFOs, to also understand kind of their outlook on on if they're trying to do kind of maybe some more research and development. Are they working on acquisitions? And if they tell us that, for us, if we're trying to buy a new company and go through a merger, if our portfolio managers think that's maybe not the best use of their cash, then there's a real chance that our team can maybe lower that allocation or get out of that stock completely. But if the team fully understands the executive's kind of plan and layout for what they're trying to accomplish as a firm and that pile of cash and how it's going to be working, then we are squarely focused on that. And if you go back from a historical perspective, when you own these kind of big giant names like your JP Morgans, your Broadcoms, your Exxon Mobils, your Home Depots, Johnson and Johnsons, they tend to hold in significantly better when the overall market is kind of selling off and maybe getting a little bit ugly and having some really tough performance. I always think back to 2008, obviously, one of the worst markets for really anyone on this call, is that we will absolutely lose money. We will not always just be positive performance. Our goal is to lose less than the overall market. And we did that back in 08. We did that back in 2018. We did that back in 2022. So our goal is to kind of be that really bedrock of an anchor of a portfolio where we will continue to hopefully generate positive return for you. If the market is a straight up kind of bull market, which we have seen here very recently with tech and AI driving things higher, we will not fully participate in all of that upside. But if that were to slow down and kind of roll over and maybe have a tough year at it, I would expect a portfolio that's made up of all these high quality companies with generating free cash flow to hold in significantly better. So if you are exposed to more kind of growthier names and tech exposure in your portfolios, having a fund like this on the other side of the spectrum can be a really nice kind of counterbalance to those more aggressive names. And during a time like this, when we have seen tech valuations reach sky high levels, and I think people get a little bit nervous about that, having a portfolio like the dividend income fund can help offset and kind of mitigate maybe a little bit of that extra risk that may be out on the tech and the growth side right now.
Okay. All right. Thanks a lot, Nick.
Mm-hmm.
A lot of positive attributes there. Okay. If anybody else has a question, please let me know. If you're more comfortable sending in a chat, you could certainly do that. And then while people are, if they have any questions, I have another one that I'm thinking about, and this is more of a hypothetical. So hypothetical scenario. I'm just XYZ investor, and hey, I'm really concerned about a potential recession. I don't know if there's going to be one or there isn't. I've been told, hey, in a recession, stocks generally don't perform too well, at least not in the early phase of it. So what I think I want to do is not heed the advice that you just mentioned, and I want to dump my stocks. I want to more or less hide in money market CDs and get some earnings. I just want to kind of hide out. So could you describe a little bit of the potential downsides of that strategy, of the difficulty of getting the timing right,
Yeah.
or the difficulties in missing out on good moves? So I'd appreciate that.
Yeah, that's a good question, and that's one that comes up a lot during the course of doing kind of client events and client seminars, and during periods like this when there are a lot of questions, right? Are we going to slow down, and have a soft landing in the economy, or are we going to slow significantly into some sort of recessionary like environment? And it is really hard to kind of forecast that, and to make the decision to take your whole portfolio, as an investor, or a large chunk of your portfolio of your investments. you have to be right multiple times for it to work, right? So essentially you have to sell all your investments at the peak of the market. You have to nail that exactly right on. You have to wait for all of the turmoil and damage in the market to happen. And then you have to be willing, when things are at their darkest in the economy and the market, to go fully back into the market. I don't know hardly anyone who has that ability, right? If you think back to 2008 and 2009, right, we had one of the worst environments for stocks that we've really ever seen. And we saw a lot of people sell their investments while the market was going down. So they were locking in losses as the market was falling. And they said, no more, no more. I can't take this anymore. I'm out. So the majority of investors sold out when the market was nearing the bottom already. And then they sat in cash and they waited and they waited, because they just went through one of the most painful periods of investment losses ever. But at that same time, the market was starting to slowly recover. You would maybe have the market kind of shift up a little bit higher on you. And as the investor, it was like, no, this is just, a quick little blip. The market would maybe shift down just a little bit. That investor felt kind of vindicated, but then the market would maybe just move a little bit higher. The amount of cash that sat on the sidelines from 2009 to 2015 it's almost unheard of. But that is when all the gains are usually made, is in the first third of a bull market. So if we were to get some sort of recession, you have to be a phenomenal investor. You should be running billions of dollars if you're this good, to time it perfectly and be willing to go back in when things are the darkest. But the bulk of returns are made very early on at that start of a new bull market. But it's when things are scary and terrifying. And if you think about the news and kind of media environment that we currently live in, right, they sell fear. They don't sell good news. They attract commercials and marketing dollars through viewers. And what catches viewers' attention? It's bad news. So you will continue to be fed bad news and scare tactics to keep you off the sidelines. So our view is, yes, you know what? There will be periods in the future, it may be tomorrow, it may be 10 years from now, where the economy will slow into some sort of recessionary-like environment. If you are nervous about that, I always recommend talk to your advisor, talk to your team. It always makes sense to have some cash on hand, right? Have 6 months of a reserve, a year's worth of reserve on hand if you really need that. You can have it somewhere liquid like a money market or a CD. But having excess cash in that type of investment, you will be left behind and you'll be left on the sidelines. If you're nervous about, am I going to run out of money in the next 10 or 15 years? Talk to your advisor about your risk tolerance. Your advisors have different types of portfolios they can put you in that can be very aggressive and capture a lot of the upside, but will lose more when things go bad. But there are investment portfolios that you can be allocated into that maybe are less risky, where you won't get a lot of upside, but you won't participate in a lot of the downside either. So if you're having these thoughts as an investor, I can't recommend enough reaching out to your advisor and just have a simple conversation of, am I in the right risk tolerance? What could happen if things go bad? But at the same time, what if things keep going? What if the market continues to grow? And I always just really, really think back to that 08, 09 scenario where there was just so much cash and so much opportunity cost that was lost from people being nervous and scared and not working with their advisor to understand that we're investing for the long term and not just for the very short term periods.
Okay. All right, thanks a lot for your perspective and all your viewpoints on that question. Okay, I think we're coming up on time, and I don't see any other questions on the line here. So I think we're coming up on time, and I think we're going to wrap things up.
Perfect.
Nick, thank you very much. Really very educational. Thanks for supporting DBHW and our clients. We all really appreciate it.
You're welcome.
And
Thank you.
And thanks for the support of Columbia Threadneedle.
Absolutely.
So
I appreciate the time today, everyone. If you have additional questions, if you want to filter them over to Pat, I'm happy to kind of answer any questions through Pat that that may pop up afterwards. So really appreciate it, everyone. Thank you.
okay, thanks, Nick. Andrea, if I think we can probably stop the recording.